Right. So coming to the next integrated case study, CA Kamlesh Datta was appointed as the engagement partner on behalf of Datta and Associates for conducting the audit for the third consecutive year of Pramath Limited, an unlisted public company with a turnover of 35 crore during 29-30. From financial year 30-31 onwards, Pramath Limited had voluntarily adopted to prepare its financial statements as per the Division 2 of Schedule 3 of the Companies Act, due to which Datta and Associates had revised the terms of audit engagement for the current audit engagement. As per the revised terms, it was decided that the auditor's report on the financial statements will incorporate a paragraph in accordance with 706, drawing attention to the additional disclosures. Moreover, it was decided that management will also present the appropriate disclosures in the financial statements with respect to this change. While auditing the entity, CA Kamlesh came across a business policy of Pramath Limited that required to invest some portion of its money earned in the business in its business in securities of different blue chip companies, and due to this reason almost 55% of Pramath Limited total assets consisted of such investments. These securities transactions were handled by its broker company River Securities Private Limited. RSPL was also performing the necessary investment account reconciliation and also preparing the M2M gain and loss calculation for the entity. Pramath Limited used to rely upon the calculations performed by RSPL, and based on that, they passed the MTM entry for their current investments every month. Pramath Limited were relying on the controls present in RSPL for the preparation of this entry. They also listed controls, yes, they also listed controls present in RSPL in their risk control matrix as key controls. The EQCR CA Tushar recommended CA Kamlesh to obtain a Type 2 report from the management of RSPL, to which CA Kamlesh said that it was not required to do so as management was already comfortable with the controls present in RSPL. Further, while conducting the audit, CA Kamlesh observed that investments in certain securities were sold at a price less than the price at which they were acquired, and he did not report on such matters under Section 143(1) of the Companies Act without even considering to inquire into the propriety aspect of the same. CA Kamlesh made the following observation while examining the financial statements prepared by the company as per Division 2 of Schedule 3 of the Act for the first time. Other non-operating income and expenses related to it were shown separately in the statement of profit and loss. Trade payables which are payable after 12 months and deferred tax liability were shown directly under the head non-current liability. While finalizing the audit report, CA Kamlesh prepared a letter containing key important points to be communicated to TCWG Audit Committee of the entity. This letter was prepared in addition to the audit report. The audit team was of the view that for the above mentioned letter, the audit team is required to generate a UDIN. On the basis of the above, answer the questions. Okay, so one, we see a question regarding the SA 70 point regarding the 706. Then we understand that more than 5% of the total assets are the investment asset. Then they've outsourced this work to the RSPL. So for that, they are saying a type 2 report, but it says it is not required. Then after that, they say no inquiry made under 143(1), where share securities debentures have been sold at a price less than the price at which they were acquired by the company. And then certain point regarding the Schedule 3 disclosures. And then in the communication to TCWG, the UDIN has not been mentioned in the communication to TCWG. While finalizing the audit report, CA Kamlesh decided to present the early adoption of Ind AS under the other matter paragraph, as in the auditor's judgment it is relevant to the user's understanding of the audit, the auditor's responsibility, or the audit report. Kindly guide CA Kamlesh with respect to the correct reporting in the audit report. So is it a matter related to the financial statements? Yes. Is it already disclosed in the financial statements? Yes. So in that case, auditor, you should not put it in the other matter. It should be coming under the emphasis of matter. No disclosure is required as it is voluntary adoption. No. The audit team should report the change in the EOM because in the auditor's judgment it is fundamental to the user's understanding. Audit team should report the change on the other matter as it is fundamental. No. No, we always know the combination that for emphasis of matter, it is fundamental to the user's understanding, and for other matter, it is relevant to the user's understanding. So this is a wrong combination. Audit team should qualify as per 705, the said change as it is not required to be implemented, and this will create unnecessary confusion for the reader. So again, no. So B would be the correct option. Kamle's risk assessment includes an expectation that controls at the service organization are operating effectively, and he contended that there was no requirement to obtain a Type 2 report. Kindly guide CA Kamlesh with respect to the requirement of 402. So either you obtain a Type 1, Type 2 report, or you contact the service organization, or you appoint for another auditor to perform the TOC at the service organization. CA Kamlesh contention is correct as management has comfort over the controls at the service organization. When the user auditor risk assessment includes an expectation that controls at service organization are operating effectively, user auditor shall obtain evidence about the operating effectiveness of control, which may include obtaining a Type 2 report. It depends upon the auditor's judgment, and the recommendation of the EQCR is not binding upon the audit team. As the result, Kamle's decision will be considered correct and appropriate, as no services are outsourced to broker company, and hence there is no need to obtain the Type 2 report. So no need to consider what EQCR is saying, right? It says the contention is Kamle's contention is correct. No, it says what is the correct option, that auditor you will obtain evidence in the form of a Type 2 report. Okay, whether it is justifiable that CA Kamlesh didn't report on the matter with respect to the sale of investments even without inquiring about the same. Right, so we have 143, 1A, B, C, D, E, F. What is C? Where the company is not an investment or a banking company. Shares, securities, debentures have been sold at a price less than the price at which they were purchased by the company. But here it looks like the company is a investment company, because more than 50% of its assets are the investments. Right? So in that case, you don't need to inquire whether shares, securities, debentures have been sold at a price less than the price at which they were sold by the company. Okay. Right, so whether it is justifiable that Kamlesh didn't report on the matter with respect to sale of investments even without inquiring for the same? No, as at least CA Kamlesh should have inquired into such a propriety matter. Yes, it is not mandatory for the auditor to report on the matters. Yeah, only if he has an adverse finding we report. No, he should have at least consulted a CA Tushar before doing so. Yes, as the relevant clause for reporting is not applicable in case of Pramat Limited. Well, because what does 143(1)(3) say? Where the company is not an investment or a banking company. That means for investment banking company, that inquiry is not required. Okay. Identify the error, if any, in the preparation of financial statements by the company as per Division 2 of Schedule 3 from the observations made by CA Kamlesh. Other non-operating income should have been shown by netting of the expenses related to trade payable and deferred tax liability should be shown under the subheading financial liability under the head non-current liability. So it says other non-operating income should have been shown net of the expenses, and trade payable deferred tax liability should be shown under the heading financial liability under the head non-current liability. Then trade payable and deferred tax liability should be shown under the subheading financial liability under the heading of the right non-current liability. Same point. Okay. Other non-operating income should have been shown by netting of the expenses related to it, right? So this is similar point. Other non-operating income should have been shown netting of the expenses, and trade payable should again be shown under the heading financial liability, right? Trade payable should be shown under the heading financial liability under the heading non-current liability. And the last one, only the third is trade payable should be shown under the subheading of the financial liability under the heading non-current liability, right? So now that one point is common, right? Under the heading of the non-current liability. Now what does it say? Other non-operating income should have been shown netting of the expenses related to in the trade payable, right? Under the trade payable, right? So this point is also same. And then it says deferred tax liability, right? So deferred tax liability, no. It says the trade payable should be shown under the heading of the financial liability under the head non-current liability. Right? So that's the only difference. Here it says trade payables and deferred tax liability. We say only the trade payable. And CA Kamlesh was not sure with respect to the UDIN requirement for the letter to TCWG containing important audit topics and findings for discussion. Kindly guide CA Kamlesh with respect to the UDIN requirements for this letter. It's obviously when you report to the shareholders, UDIN is required. For communication with TCWG, UDIN is not required. So separate UDINs are to be generated for stat audit report and TCWG letter. UDC is only required for stat audit, but it is not required for communication under 260, 265. One single UDIN is required to be generated for all items for this client. UDINs are required to be generated client-wise instead of report-wise. One single UDIN will be generated for the whole year for this engagement, which may include various communication by auditor to management, PCWG. No. Right, so B is the correct option. UDIN is only required for the stat audit report, but it is not required for the communication performed by the auditor as per 260 and 265.